Hi guys, welcome back to Anoothie Financial Bytes. I hope you all are doing well. So our today's topic is leverage. So under this topic, I'll cover financial leverage, operating leverage and combined leverage one by one. So in a simple terms, what is the leverage? Leverage is basically, leverage tells you about that whether a company is using debt in its capital structure or not, along with equity. So there are number of instruments, financial instruments through which company raises funds. We all know, like there's equity, there's preference stock, there are debentures, there are bonds. So we need to find out whether company is using any fixed income instruments in its capital structure or not. So and how it will impact in our decision making with respect to investment being made by us in such companies, because when a company is using any fixed income instrument in its capital structure, it will become mandate for a company to pay a certain amount, to pay interest amount on that fixed income instrument. That is why it is called fixed income instrument, right? So it becomes mandate for a company, irrespective of any situation that company is facing, to pay a fixed interest amount as per the agreement to the investor. So it has a bearing, or it has an impact on earnings per share, or the earnings that shareholders will be getting after deducting all the mandate payments with respect to preference dividend, with respect to interest on debentures and all that thing. So first, talking about operating leverage. So I'm going to tell you about what is operating leverage. I'm going to change its color so that you won't get confused. Operating tells you the relationship between contribution and EBIT. So the lower will be the operating leverage, the more profitable it will be for you, because its formula is contribution upon EBIT. So in my previous video, I told you about what is contribution and what is earning before interest and tax. So it basically shows the relationship between contribution and EBIT. So the lower the operating leverage will be, the more margin of safety an investor will have. Then under this operating leverage category, there is degree of operating leverage, which basically tells you about the percentage change in sales with respect to percentage change in EBIT. Percentage change in EBIT with respect to percentage change in sales, which shows that if there is a unit percentage change in sales volume, how it will affect the unit percentage change in earnings before interest and tax. So it basically is being told by degree of operating leverage. So operating leverage tells you about the margin of safety that an investor will have. After this, after operating leverage, there is another leverage which is called financial leverage. Now financial leverage is the relationship between EBIT and EBT. EBT is earning before tax. Now I'll tell you the difference between earning before interest and tax and earning before tax. Earning before interest and tax is that interest and tax both are not yet deducted from your earnings, from the company's earnings. Whereas earning before tax, only earning before tax, it shows that interest is deducted out of it, but tax is not deducted yet. So I told you previously that interest is tax deductible expense, so it is deducted before tax is deducted from the company's earnings. So it is basically EBT, earning before tax, which shows that interest is deducted but tax is not deducted, and EBIT is basically earnings before interest and tax, which shows that neither interest nor tax is deducted from earnings of the company. So financial leverage is EBIT upon EBT, which shows the relationship between EBIT and EBT. So it basically tells you that whether company is using any fixed income instrument or any kind of debt instrument in its capital structure or not, which shows the riskiness of the company, which shows whether the company is bound to pay any fixed income to the investors before paying dividends to equity shareholders. So the more financial leverage is, the more riskier the company will be. Therefore, the low financial leverage is, the less riskier will be the company. So an investor needs to go through these two leverages before making any decision with respect to investment in a particular company. Now, if an investor selects a particular company, before selecting a particular company, investor needs to find out which industry he should focus upon as per the prevailing economic scenario, and the number of factors that the industry which reflects whether the industry will prosper in future, whether the industry will grow in future or not. So after deciding a particular industry, like in today's scenario, the e-commerce industry the e-commerce industry is growing and it will grow further. The digital industry, the IT sector, the pharma sector, these sectors have growth prospects within them. After selecting a particular industry, we need to check which company based on these leverages should be selected for our hard-earned money. Then after this leverage, I'll tell you what is combined leverage, because in some cases the operating leverage is low and financial leverage is high. So I'll tell you what does that mean. So you can check that by finding out the combined leverage. So combined leverage is equals to financial leverage into operating leverage. Now financial leverage, I told you, that is C upon contribution upon EBIT. Operating leverage, I told you, EBIT upon EBT. So when these two ratios are multiplied with each other, EBIT gets cancelled and it will come out as contribution upon EBT, which shows that if a company has operating leverage which is lower and if the financial leverage is higher, so still you can prefer that company, because the lower operating leverage will give you higher margin of safety, which will give you a space to cover the financial risk or the financial leverage, high financial leverage. I'll repeat. If operating leverage is lower, it means you will have more margin of safety, which will give you more space to cover the high risk due to high financial leverage, due to high fixed income instruments present in the capital structure of the company. So that can be found out by combined leverage. So these are the things you need to look for before investing in a particular company. These are called fundamentals, and these fundamentals will tell you what will be the company's economic value added and what the company has been earning in terms of economic value added, and whether the company will be able to give you returns in form of dividends or capital appreciation in coming times. So I hope you like my video. If you like, do view, like and subscribe to Anoothie channel, and I'll keep coming up with more topics pertaining to financial bytes. So till then, stay tuned to Anoothie Financial Bytes. See you. Bye bye. Take care.